You do not have a lot of time to deep dive into researching individual companies, and you still like to stay invested in the market to let your money work for you and see the magic of compounding growing your money over years. Moreover, you would like to minimize your risks on your hard earned money. I believe this video will provide a solution to all these questions. So please do watch till the end, where I'll be sharing how much monthly investment can take this investment of yours to $1 million. Welcome back, friends. Today I'm going to present my analysis on S&P 500 index. S&P 500 is a stock market index that measures the stock market performance of 500 large companies listed on stock exchanges in the United States. This index has also been highly recommended by the great investor Warren Buffett. I have analyzed the data of the past 50 years for this video, that is from the year 1970 to year 2019. The chart here shows the annual returns of the index for the past 50 years. Green bar shows the positive return in a particular year, and the red bar shows the years with the negative returns. Out of 50 years, there were 11 years with negative returns, worst being the year 2008 with over 37% dip. The rest of the 39 years, which is around 78% of times, the index returns positive returns overall. Annual returns have a wide variation, with the worst year being minus 37% and the best year of 95 ending up giving plus 37% returns to the investors. This is too volatile for any investor, especially who would like to stay invested for a short term, which is few months or a couple of years. In a minute, I'll show you how you can reduce this volatility and increase the probability of gaining positive returns from the S&P 500 index. Another interesting observation is that in the history of 50 years, if we focus on yearly returns, there has been two instances when returns have been negative for consecutive 3 years. Once it was during 1973 to 1975, and another was during the 2000 dot-com bubble burst. 2008 being the worst year performance wise, still S&P 500 index returned positive returns in the year 2009. Now let's see what kind of returns you can expect if you increase the holding period from 1 to 3 years. This chart here shows you the percentage CAGR returns for every 3 years calculated from past 50 years of data, which means the returns you will get in any given year if you hold onto the index fund for the past 3 years. Because we are calculating 3% CAGR now, 3 years of percentage CAGR now, we have total 48 data points in this chart. Out of 48, 8 years gave negative returns, and the remaining 83% of the time it ends up giving positive returns. Interesting thing to note here is that when we increase the holding period from 1 year to 3 years, the years with positive returns become more prominent and the percentage of negative returns start decreasing. And the time period when we get negative returns are correlated to major events happening across the world, like dot-com bubble burst and 2008 global recession. And if we further increase the holding period to 5 years, our negative red bars keep shrinking in size. On the basis of holding period being 5 years, you will get positive returns 74% of the time. That means 3 out of 4 times you will be net positive. And 43% of those times you will have overall returns higher than 10% CAGR. The worst return here in this chart is minus 6% in the year of 1974 and minus 4% in the year 2004 and 2008 on this CAGR basis. And something magical happens when we start looking into 10-year CAGR data. It gives you positive returns 93% of times. And even during the crashes like that of dot-com bubble burst, you would be sitting at net positive returns. 41% of the times it is expected to return you over 10% CAGR. And if you see in the chart, there are many years returning very close to 10%. To put things in perspective, the worst year will see minus 3% CAGR. In my opinion, the best use of index investing is when you do not have time or knowledge to indulge into researching of the individual companies and still would like to stay invested in markets. Also, if you start investing early in life and keep investing monthly, be it a big or a small investment, at your convenience and let the compounding play its role. Now let's look at how much times one could have gained over if you would have stayed in the market over your professional career timeline. So this table shows what were the CAGR returns on the S&P 500 from 1970 to 2019, assuming different holding periods varying from 3 years to 50 years. We see that the returns vary from 7% to 13%. I personally would recommend to invest even if you are investing a minimum amount but a consistent amount in the index for a long durations. If you start early in your professional career, when you start earning, stay at an age of 15 to 18 years and put a minor cut of your savings in the index fund every month and keep it untouched during your professional career. 3 years returns look impressive here, but it comes with a caveat. They come with much more volatility associated with it in comparison to the long term investments, which means the probability of results being repeatable decreases on a 3 year basis. As we have seen, volatility decreases with longer time in market. Getting a 7 to 9% or 10% CAGR returns over a period of 30 to 50 years is simply excellent. And let's see why. Let's look into what the X multiple, that is, how many times your annual investment will become after staying invested for a period of 30 to 50 years. To explain this in a bit detail, suppose you invest $1 every year in S&P 500 index and you do this for 30 years, and let's assume you get only 7% CAGR. You would be sitting at $101 or 101 times your annually invested amount after 30 years, which is equal to the 33 times your total invested money over the period of 30 years. And similarly, on the other end of the spectrum, if you were lucky to get 13% CAGR for long durations of 50 years, your $1 of annual investment would become worth $3,909. That is almost 4,000 times your annual invested amount, which is equivalent to 80 times your total invested money over the period of 50 years. In my opinion, I would be safe. I would consider it safe to assume that S&P would be able to return in a range of 8 to 10% CAGR over the coming decades. That is depending on your holding period and how much S&P eventually ends up returning. You can expect anywhere between 122 to 1,280 times your annual investment. Now you need to pick a number of years you will be comfortable staying invested in and what kind of range of return you think you can expect. And it can help you understand what is the X multiple you are looking at. But please be aware that these calculations are based on an assumption that you keep investing the same amount every year right from year one. If you increase or decrease the annual investments, results will differ. This table is my favorite part of this video. So the table in the bottom shows different amounts which you would need to invest on a monthly basis to take your total investment to $1 million. As expected, longer you stay invested, your monthly investments decrease. So let's assume that you have a conviction that S&P 500 would be able to return 9% CAGR in a long run, and you're comfortable to stay invested for say 40 years. Monthly amount you need to invest would be around $226. And if you are an investor with more conservative approach and would like to assume the returns to be only 7%, and say you want to hold it only for 30 years, I'm saying only just from the table perspective, you would need to invest around $825 every month to hit the $1 million mark. And if you are someone who are more confident in the higher returns you can get from in coming decades and assume it to be 13%, and also you can stay invested for longer durations of 50 years, you need to just invest $21 every month to make it $1 million. That's all from my side, guys, in this analysis. Please do let me know your thoughts in the comment section below. do like and share if you like it. And please let me know if you would like such kind of analysis videos in the future. And don't forget to subscribe to the channel and for future videos. Thanks for watching and see you in the next video.